Hi there, and welcome to another Stock Insights video on Stock Market Palantir. Make sure to hit the subscribe button and drop any comments. Now, let's go for the analysis.
Okay, let's just look at the tape. Because the numbers from January 21, 2026, they tell a really fascinating story. It goes far beyond a simple price chart. Lucid Group, ticker LCID, it capitulates down to a new 52-week low of $9.50. And right at that moment, it looks like the floor is just, falling out. The capitulation trade is on. But then we see this violent immediate reversal. The stock rips approximately 22% off those lows to reclaim the $11 level. And this wasn't on thin liquidity or some kind of after-hours glitch.
23.28 million shares traded that day. Now, compare that to the average session of roughly 8.6 million, and you're looking at a 167% spike in volume. That is institutional grade movement. But see, I come at it from a different way. You look at that chart and see a heroic recovery, a hammer candle marking the bottom. I see a classic volatility trap. That volume spike looks like desperate short covering, not organic institutional accumulation.
I see why you'd think that, but let me give you a different perspective. That volume represents a realization by the market that the zero value outcome for Lucid is effectively impossible. We are looking at a company that is being mispriced as a failing startup, when in reality it is transitioned into a quasi-sovereign entity. The central question for our debate today isn't about cash burn anymore. It's about whether Lucid is a distressed asset heading for a restructuring or a massive asymmetric trade backed by the Saudi Public Investment Fund.
That is the narrative battle, sure. You're calling it an asymmetric trade. I'm calling it a broken equity structure. We have to talk about the short interest, the dark pool activity, and the operational reality of their inventory, because that is what is actually driving this price action, not some geopolitical theory.
I'm ready to dig in. I'm taking the position that the sovereign put option, the backing of the PIF, combined with their technology leadership, makes this a misunderstood long-term play.
And I'll take the other side. Market mechanics, massive inventory overhangs, and, well, a reliance on a single backer make this equity a very dangerous place to park capital right now.
All right, let's start with my position. The market is currently treating Lucid like it's Fisker or Lordstown Motors, a company that could just run out of cash and disappear. That view completely ignores the geopolitical arbitrage. The Public Investment Fund of Saudi Arabia owns approximately, 54.6% of this company. They have poured in over $9 billion. This isn't just an investment. It is a pillar of Vision 2030. Just recently, Cantor Fitzgerald issued a note confirming that the PIF's commitment is material.
Right. But being foundational doesn't mean the stock price goes up. It just means the lights stay on.
It means the floor is solid. And operationally, the Q4 2025 numbers show the manufacturing hell is over. Production was up 116% quarter over quarter. They are scaling. And with the Gravity SUV winning efficiency awards left and right, the technology holds an intrinsic value that its peers simply don't have.
Intrinsic value doesn't pay the electric bill. Here's my position. The fundamentals are deteriorating despite the backing. You mentioned production, but you just glossed over deliveries. In Q4, they produced 8,412 vehicles, but only delivered 5,345. They built over 3,000 more cars than they could hand over to customers. In a single quarter, they manufactured a parking lot full of depreciating assets. That divergence creates a massive inventory overhang. And while the PIF prevents bankruptcy, they do it through dilution. Every time Lucid eats cash, they print more shares. The stock becomes a dilution machine. And frankly, the silence from the insiders, the lack of buying, tells me they know it too.
Okay, you've thrown a lot on the table there, so let's strip this down to the mechanics first. Because that January 21 move was technical. You called it a volatility trap. Walk me through the plumbing of that trade.
Okay, we have to look at the short interest. Right now, about 45.6 million shares are sold short. That is roughly 34.98% of the float. In the world of large-cap equities, that is an incredibly crowded trade. It's nearly a third of the tradable shares being bet against the company. But what's more concerning, and this is where it gets opaque, is where that trading is happening.
You're referring to off-exchange data.
Exactly.
The data shows that 62.77% of that short volume is occurring in dark pools. For the listeners who aren't glued to terminal screens, dark pools are private exchanges where institutions can trade without displaying their orders to the public immediately. So when you have nearly 63% of the selling pressure hidden there, it masks the true negative sentiment. These institutions are betting against the company without tipping their hand on the lit exchanges like the NASDAQ.
Which, I mean, that essentially proves my point about the coiled spring, doesn't it? If the selling is that crowded and it's that hidden, any positive catalyst forces a violent unwind.
It creates volatility, yes. The days to cover ratio is sitting between 3.5 and 5.3. That means at average volume, it would take shorts a full week to buy back their positions. So when you saw that spike on January 21st, that wasn't investors falling in love with Lucid again. That was a mechanical squeeze. The shorts in the dark pools got nervous about the 950 floor, perhaps fearing a buyout rumor or a capital injection announcement, and rushed to cover.
I'm not convinced by the just squeeze reasoning because it ignores why they rushed to cover. Fentel data showed share availability dropped to 1,000 shares on that day. 1,000. The cost to borrow, the interest rate you pay to short a stock, spiked dramatically. Why? Because the market digested that Cantor Fitzgerald note. The shorts realized that betting against a company backed by a sovereign wealth fund is suicide. The PIF has effectively created a sovereign put option. You cannot short this company to zero.
You can't short it to zero, perhaps, that you can certainly lose money owning it while it bleeds out. You're talking about a floor. I'm talking about a ceiling. And right now the ceiling is being lowered by the options market. Look at the 30-day implied volatility. It's ranking in the 43rd percentile, but the premiums are priced for extreme moves. The market makers are pricing in disaster or a moonshot, nothing in between.
I'd argue they are terrified of the moonshot. But let's pivot to the operational reality you mentioned, because that's the biggest counterargument to my thesis. You brought up the gap between production and deliveries, 3,000 cars sitting in inventory.
It's the elephant in the room. Producing 116% more cars quarter over quarter sounds great in a press release, but delivering only 31% more? That suggests a demand ceiling for the Air sedan. They are building cars for buyers that don't exist yet. This burns working capital. Those cars sit, they age, they need maintenance, and eventually they get discounted. It crushes margins.
That's the bearish view, certainly, but I would frame it differently. You're viewing that inventory build as a failure of demand, but the evidence suggests it's a strategic positioning of supply. We know that the AMP2 facility in Saudi Arabia is shifting from simple assembly to full manufacturing. A significant portion of that Q4 production gap is inventory in transit, vehicles moving to distribution centers in Europe and the Kingdom to fulfill the Saudi government's 100,000 vehicle order commitment.
In transit is the oldest excuse in the automotive book. It's the dog ate my homework of earnings calls. If they were sold, they would be marked as delivered or at least in transit to customer. This is in transit to inventory. It's shifting metal from one parking lot to another.
But in this case, the homework is actually due. They are prepping for the launch of the Gravity SUV. They need the inventory channels filled before the Gravity hits full volume in Q1 and Q2 of 2026. And frankly, I think you and the market are ignoring the strategic pivot Lucid made on January 5 with the Uber and Nuro partnership.
I saw the headline, Global Robotaxi. It felt like buzzword bingo, a desperate attempt to draft off the Tesla narrative.
It's not a distraction, it's a business model evolution. Lucid is positioning itself to be the Intel Inside for autonomous fleets. By partnering with Nuro for the AV stack and Uber for the network, Lucid leverages its one true moat, efficiency. Their miles per kilowatt-hour advantage translates directly to profit for a fleet operator. They don't have to solve self-driving, they just have to provide the most efficient hardware for it. This reduces reliance on direct consumer sales, which helps address your concern about the sedan demand ceiling.
I'm sorry, but I just don't buy that timeline. Let me tell you why. The robotaxi play is a long-duration, high-execution risk strategy. Lucid is currently fighting for survival in the EV winter. They need to clear that sedan inventory now, before the Q1 financials in February. If they are sitting on working capital trapped in 3,000 unsold cars,
A partnership with Uber that might yield fruit in 2028 doesn't help the cash burn today. It's a nice story, but it doesn't pay the suppliers.
It provides the narrative bridge, though, and narrative drives valuation multiples.
Speaking of valuation, let's look at how Lucid stacks up against its peers. The disconnect is glaring. Lucid has a market cap of around $3.7 billion. Compare that to Rivian at roughly $20 billion.
Rivian is a different animal.
It is, but the comparison matters for capital allocation. Rivian has a product that actually fits the American market, pickup trucks and rugged SUVs. They have diversified backing from Amazon and Volkswagen. Lucid is singularly reliant on the Saudis. Or look at Tesla, at $1.4 trillion. Lucid is trading on the hope that it can capture a fraction of Tesla's magic, but the gap is widening. And we have to mention Polestar.
Why Polestar?
Polestar just executed a 1-for-30 reverse split. That is the ghost of Christmas future for Lucid. Polestar had good design, good backing from Geely, and yet the stock collapsed to the point where they had to consolidate shares just to stay listed. If Lucid can't generate organic demand, they risk the same fate. A reverse split is essentially an admission that the equity story has failed.
The Polestar comparison is flawed. Polestar is an integrator. They rely on Volvo and Geely platforms. They don't own their core technology in the same way. Lucid's proprietary powertrain technology, the motors, the miniaturization, holds intrinsic value. That's why Cantor Fitzgerald has a $21 price target. They aren't looking at today's cash flow. They are looking at the geopolitical arbitrage. The PIF hasn't just invested money, they've invested reputation. For them to let Lucid fail would be a reputational disaster for Vision 2030. That $21 target reflects the reality that the Saudis will likely take this private or inject massive capital before they let it collapse.
But Morgan Stanley has cut their target to $10, calling it underweight. Their analyst Adam Jonas makes a very simple point. Profitability is delayed until 2028. That means years of dilution. And regarding your sovereign puts theory, if the turnaround is so guaranteed, if the $21 target is real, where are the insiders?
What do you mean?
I'm looking at the Form 4 filings, the legal disclosures of insider trading. We see executives like Eric Botch selling shares. Now, I know much of that is for tax obligations on RSUs. That's standard. But what we don't see is a single open market purchase from the C-suite. The stock hits an all-time low of $9.50, a fire sale price according to your thesis. And yet, the CEO, the CFO, none of them are reaching into their own pockets to buy shares. If they believe the sovereign put guarantee to double from here, they would be buying. Their silence is deafening.
I think you're placing too much weight on insider optics and not enough on the macro sentiment signals. In this market environment, fundamentals often take a back seat to algorithmic correlations. We need to look at how Lucid correlates with the broader sector, specifically through alternative data like Polymarket.
This is where I think the meme nature of the stock shows up. It stops being a car company and starts being a derivative.
It's not meme behavior, it's sector correlation. There isn't a direct liquid prediction market for Lucid on Polymarket, but it drafts heavily on Tesla. When Polymarket confidence in Tesla mentioning robotaxi hits 97%, as we've seen recently, Lucid rallies. The market understands that if the future of transport narrative is a lie for Tesla, it validates Lucid's technology. Lucid is a high beta derivative of that sentiment.
Exactly. That's my point. It's a derivative trade. It doesn't trade on its own merit. It trades on Elon Musk's coattails. And looking at other Polymarket data, look at the bets on FedEx mentioning EVs in their earnings. The probability is low. That suggests cooling B2B interest in electric fleets. That is a direct headwind for Lucid's hopes of selling fleets to logistics companies or the Saudi government. If the industrial will isn't there, the narrative crumbles.
The industrial will is there, specifically in Riyadh. You're ignoring the AMP to expansion. The fact that they are moving to full manufacturing in Saudi Arabia proves the commitment is physical, not just financial. The Saudis aren't building a factory for a company they plan to let die. That physical infrastructure is the bridge to the Gravity launch.
A factory can be repurposed, a balance sheet cannot. But let's go back to the catalyst, the Gravity SUV. You say the inventory build is for Gravity.
It is. The Gravity recently won the Best Tech Award from Motor Trend. It's on Car and Driver's 10 Best list. The critical reception is stellar. This is the product that moves Lucid from a niche sedan manufacturer to a competitor in the volume SUV segment alongside the Model X and Rivian R1S. It changes the unit economics.
Awards don't pay the bills. The Model X is a tiny fraction of Tesla's volume. The premium SUV market is crowded. If they launch Gravity and we see the same production delivery gap in Q2 2026 that we just saw in Q4 2025, the market will punish them severely. They are burning cash to build capacity for a vehicle that has to succeed immediately. There is no ramp-up grace period left.
They have the runway because of the PEF. That is the fundamental disconnect in our views. You're analyzing Lucid as a standalone company subject to normal market discipline. I am analyzing it as a strategic asset of a G20 economy. The PIF has pumped in $9 billion. They aren't going to let a working capital hiccup in Q4 2025 derail a centerpiece of their economic diversification strategy.
But at what cost to the equity holder? The PIF prevents bankruptcy. Yes, I agree with you there. But they do it through dilution. If the Saudis have to inject another $2 billion, they will take more equity. The existing retail base gets washed out. So the company survives, but the stock price at $11 might be $5 in a year because the share count has doubled. That's the unshortable zero thesis. It's too dangerous to short because the Saudis might pump it, but it's too dangerous to buy because the dilution is endless.
I disagree on the dilution inevitability. The Gravity launch changes the unit economics. Once they fill the AMP1 capacity, the fixed costs per unit drop dramatically. We are on the precipice of operating leverage. The January 21 capitulation was the bottom. The shorts are trapped, the technology is validated by the Uber deal, and the backer is unwavering.
We will see. To me, the lack of insider buying and the massive inventory overhang speak louder than a partnership press release or a tech award.
So bringing this all together, we are looking at a stock that just bounced 22% off a capitulation low. I firmly believe Lucid represents a massive asymmetric upside. You have the sovereign put from the PIF capping your downside, they simply won't let it fail, and you have the launch of the Gravity SUV providing the catalyst for a repricing. The market is treating it like a dead company walking when it's actually a well-capitalized tech leader entering its most important product cycle.
And I'm staying cautious. I see Lucid as an unshortable zero. It's a dangerous zombie. The PIF backing keeps the lights on, which makes it terrifying to short, but the operational fundamentals, specifically that 3,000 car inventory gap and the cash burn, make it uninvestable for a fundamental long. The stock is a volatility instrument right now. It's going to whip around based on short covering and dark pool games, not because they sold more cars.
We can agree that for the next 6 months, this ticker is going to be a battleground.
Absolutely. It's less of an investment and more of a proxy for Saudi industrial will versus American market skepticism.
And getting back to that January 21 tape, 23 million shares changing hands tells us one thing. The fight is just getting started.
That's one way to put it. The market will decide if that volume was a rescue.
If you like this video and want to watch more content like this, don't forget to subscribe to the Stock Market Palantir channel. Thanks for watching. See ya.